what was published in March was the final technical details about the most difficult and contentious part of the CSD regulation, which is the settlement discipline regime. This involves penalties, which you can also view as incentives for higher rates of trade settlement, and it also involves the complex, potentially highly administrative function of buy-ins being operated in the market. But these are all new innovations in the European market. They exist in some countries, they don't exist in others. So bringing in a harmonised, centralised settlement discipline regime for all 28 European Union member states is going to be quite a complex issue. And this all needs to be looked at in the context of the higher objective of the European Commission, which is to achieve a 99.5% settlement efficiency rate. That's a high level. Many markets do achieve that, but the figure is somewhat lower than that in Europe right now. So as we all know, the last mile, the last couple of percentage points are the hardest ones to achieve, and therefore that 99.5% figure is not going to be easy. There isn't a timetable for it. Maybe that's a reflection of the fact that it's an unknown as to how difficult it will be to achieve. But the CSDR settlement discipline regime publication earlier this year was the final part in the overall plan to achieve much higher levels of standardised settlement in the European market. This is a good example of delay being actually quite productive. The industry lobbied intelligently and quite assertively about some of the proposals in the earlier versions, particularly around buy-in regulations and the appropriateness of buy-in regulations, particularly to short-term transactions such as repo and securities lending transactions. I think this is a good example of very data-driven, productive lobbying by the industry, and particularly by AFME and the ICMA regarding securities lending and the repo markets. So I think everybody agrees it's better to get it right with a bit of a delay than it was to do it too quickly, which we've seen examples of in the past. So yeah, I think it was worth the wait. The delay has been productive, and the proposals now are much more workable than they were in the previous version. I think the CSDR probably doesn't work as a global template. Europe is a very different part of the world than anywhere else. The European Union is made up of 28 member states. The underlying laws in those 28 member states are not that harmonised around securities transactions and legal protections, etc. So it's inevitably a compromise when you get 28 member states coming together to agree on a mechanism for settlement and the penalties and incentives around failed trades. So I think the European Union is so different, so unique, that although there are a lot of valuable lessons have been learnt about what's appropriate for this type of legislation, for example, the definition of a failed trade. There isn't currently a harmonised definition of failed trade within Europe, so there will need to be one for the CSD regulation to work properly. So no, it's not a global template. A lot of useful lessons have been learned, but I don't think it's going to be copied in other parts of the world. The overall reaction is positive. Most of the market participants are pleased that the final proposals are now out there, and the real analysis work can be done. The administrative burden could be high for some of the new work that's determined by the CSDR, particularly the settlement discipline regime, and that analysis work is currently ongoing. But I think the market is very relieved that some of the more contentious points have been modified. Some of the input from the industry has been thoroughly listened to and absorbed into the new text. So yes, it's been quite a long time coming, but overall the response from the market has been quite positive. So what's next is that the legislative proposals as currently drafted need to be approved by all parties, including the European Parliament, and that's expected to conclude sometime in the summer of this year, so not that far away. Then there's a 2-year implementation window. 2 years sounds quite a long time. However, there are a large number of new builds that need to be done to achieve implementation of the CSDR, and it will be a big bang implementation. So likely to be the middle of 2018, maybe the second quarter, more likely probably the third quarter of 2018. If you are a CSD, you need to develop extensive amounts of new reporting capability. So for example, you need to decide how you're going to identify your clients and your clients' counterparties, which is all required to be reported under the CSDR. So quite a large amount of work to be done there. How do you identify those people? For example, do you use your own codes or do you use LEI codes? Quite a lot of analysis needs to be done. So the amount of work is quite considerable, even though there is a 2-year period for implementation. The other aspect about implementation is that it's 2018, which is looking like a very big year for new regulations to be implemented. So MiFID II was recently delayed, it's been deferred for implementation until 2018. So you have CSDR, you have MiFID II, you potentially have parts of the securities financing transaction reporting regulation going live in the same time frame, and projects involving the margining, clearing and reporting of OTC derivatives transactions also being enhanced under the EMIR regime. So there's an awful lot of work to be done. Everybody's going to be competing for resources because the next 2 years are very full up with new regulations and new infrastructures going on. So the work really needs to start now.